Well, thank you for being here today. You know, at 95 years old, I've seen a lot of things in my life. I've seen wars, recessions, booms, busts, technological revolutions, and financial manias. And I got to tell you, when I look at what's happening in the artificial intelligence sector in 2025, I get a very strong sense of deja vu. Now, don't get me wrong, AI is real. It's transformative. It's probably going to change the world in ways we can't fully imagine yet, much like electricity did, or the automobile, or the internet. But here's the thing I've learned in over 80 years of investing. Just because something is real and transformative doesn't mean you should pay any price for it. I've seen this movie before. The actors change, the technology changes, but the plot stays exactly the same. Human nature doesn't change. Greed and fear cycle back and forth like clockwork. And right now, when I look at the AI sector, I see a lot more greed than fear. I see a lot of speculation disguised as investing. I see people paying astronomical prices for businesses with no profits, sometimes no revenue, based purely on the promise of what AI might do someday. And you know what? I've learned that promises are cheap, results are what matter, cash flow is what matters, sustainable competitive advantages are what matter. And a lot of what I'm seeing in the AI space right now looks a whole lot like speculation, not investing. Today, I want to share with you what I've learned from watching bubbles form and burst over the past 8 decades. I want to help you understand what's happening with AI stocks in 2025, how to protect your wealth, and how to think about this sector rationally when everyone around you is losing their minds. Let me start by taking you through some history, because if you understand the past, you'll recognize the patterns in the present. I've been investing since 1942. That's 83 years. In that time, I've watched countless manias and bubbles. They all feel different at the time, but they all follow the same basic script. In the 1,960 seconds, we had the Nifty 50, a group of 50 stocks that supposedly you could buy at any price and hold forever. Companies like Polaroid, Xerox, Avon Products. People were paying 80, 90, 100 times earnings for these stocks because they were convinced growth would continue forever. Then reality set in. Most of those companies either failed or became mediocre businesses, and investors lost fortunes. In the late 1,990 seconds, we had the dot-com bubble. This is probably the closest parallel to what I'm seeing with AI today. Everyone was convinced the internet would change everything, which was true. But they also believed that old valuation metrics didn't matter anymore, that profitability was irrelevant, that all you needed was eyeballs and clicks, and eventually money would materialize somehow. I remember being criticized during that period for being too conservative, for not understanding the new economy, for being an old man stuck in the past. Companies with no earnings, sometimes no revenue, were valued at billions of dollars. Pets.com, Webvan, hundreds of others. The more ridiculous the valuation, the more people wanted in. Charlie Munger and I stayed away from almost all of it. We were happy to be boring. We owned Coca-Cola and Gillette and American Express, companies that made actual products, served actual customers, and generated actual profits. And people thought we were dinosaurs. Then the bubble burst. Between 2000 and 2002, the NASDAQ lost 78% of its value. Trillions of dollars in paper wealth vanished. Companies that had been valued at billions went to zero. And suddenly our boring old economy stocks didn't look so bad anymore. More recently, we've had the housing bubble, the Bitcoin and cryptocurrency mania, the electric vehicle bubble, where every startup with a drawing of a car was valued like the next Tesla. The pattern is always the same. New technology emerges, genuine excitement about its potential, speculation and greed take over, valuations become untethered from reality, and eventually the bubble pops. Now, here's what I want to make very clear. In every single one of these cases, the underlying technology was often real and important. The internet did change the world. Electric vehicles are the future of transportation. The tragedy was that investors paid such insane prices that even when the companies succeeded, the shareholders still lost money. Amazon survived the dot-com crash and became one of the most valuable companies in the world. But if you bought Amazon stock at the peak of the bubble in 1999, you had to wait almost a decade just to break even. You could have bought it after the crash at a tiny fraction of the peak price and made exponentially more money. This is what people always miss about bubbles. It's not that the technology isn't real. It's that you're paying prices that can't possibly be justified by any reasonable assessment of future cash flows. You're not investing, you're speculating on finding a greater fool to sell to at an even higher price. So let me explain why I think the AI sector in 2025 looks an awful lot like a bubble forming. First, the valuations are astronomical. I'm seeing companies with barely any revenue trading at market caps of billions, sometimes tens of billions of dollars. They're valued based purely on the story, on the promise of what they might become if everything goes perfectly. Now, I've been around long enough to know that things rarely go perfectly. Competition emerges, technology changes, execution is harder than it looks, profit margins compress. But right now, investors seem to be pricing in perfection, and that's always dangerous. Second, there's a lack of understanding about what these companies actually do. I've always believed that you shouldn't invest in anything you can't explain in simple terms to a 10-year-old. But with a lot of these AI companies, even the CEOs have trouble explaining clearly how they make money, what their competitive advantage is, or why they'll still be relevant in 5 or 10 years. When I don't understand something, I don't invest in it, period. That's kept me out of a lot of bad investments over the years, and it's a principle I'm sticking to now. Third, and this is a classic sign of a bubble, companies are adding AI to their name or their business description purely to pump up their stock price. We saw this exact thing during the dot-com bubble. Companies would add .com to their name and the stock would double overnight. It was absurd then, and it's absurd now. If a business model doesn't work without the words artificial intelligence in the description, it probably doesn't work with them either. Real businesses solve real problems for real customers and generate real profits. Everything else is just marketing. Fourth, there's enormous speculation from retail investors who don't understand what they're buying. I'm seeing young people putting their life savings into speculative AI stocks, people trading options on leverage, people taking out loans to invest. This is gambling, not investing. And it's exactly the kind of behavior that emerges at the peak of bubbles. Fifth, I'm not seeing durable competitive advantages in most of these companies, what we call moats. What's going to prevent a competitor with more capital or better technology from coming in and taking their market share? What's going to protect their profit margins? Why will they still be relevant in 10 years? Most of the AI companies I look at don't have good answers to these questions. They're riding a wave of enthusiasm, but they don't have the structural advantages that create lasting businesses. Let me be clear about something. AI itself is not a bubble. AI is real. It's transformative. It's already changing how businesses operate, how we search for information, how we create content, how we solve complex problems. I have no doubt that AI will be as important as electricity or the internet. But that doesn't mean you should pay any price for exposure to it. Price is what you pay. Value is what you get. And right now, for most AI stocks, the price you're being asked to pay bears no relationship to the value you're actually getting. Now, let me speak directly to those of you who are over 50, who are approaching retirement or already retired, because you're in the most vulnerable position. When you're 25 years old, if you lose 50% of your money in a speculative bet, you've got 40 years to make it back. You can save more, you can let compounding work its magic, you can recover, but if you're 65 years old and you lose 50% of your retirement savings chasing some AI stock that goes to zero, that's potentially catastrophic. You might not have enough working years left to replace that capital. You might have to drastically reduce your standard of living. You might become dependent on your children. This is why I say that after 50, your primary investment goal should be to avoid permanent loss of capital. Everything else is secondary. It doesn't matter how much the AI stocks went up if you weren't in them. What matters is that you protected what you spent a lifetime building. I've never understood the mentality of people who say, I can't afford to miss out on this opportunity. You know what you really can't afford? you can't afford to lose everything chasing a bubble. There will always be another opportunity. But if you blow up your retirement account, there's no coming back from that. So my first piece of advice for anyone over 50, stay away from speculative AI stocks. Stay away from things you don't understand. Stay away from anything that requires you to predict the future perfectly. The odds are overwhelmingly against you. Now, some of you are probably thinking, but Warren, what about the AI companies that are legitimate? What about the ones that will actually succeed? How do we think about those? That's a fair question. And the answer is you evaluate them the same way you'd evaluate any business. You look for durable competitive advantages, you look for strong management, you look for sensible capital allocation, and you insist on a reasonable price relative to current and reasonably projected cash flows. Let me give you the criteria I use when I look at any business, including AI companies. First, I want to understand the business model in simple terms. How does it make money? Who are its customers? Why do they buy from this company instead of competitors? If I can't explain this clearly, I move on.
Second, I want to see evidence of a durable competitive advantage. What makes this business hard to replicate? Is it a powerful brand, network effects, switching costs, cost advantages from scale, patents or proprietary technology that actually matter? Third, I want to see strong free cash flow, ideally growing over time. Cash flow is truth. Earnings can be manipulated, but cash is real. Show me a business that consistently generates more cash than it consumes, and I'll show you a business worth owning. Fourth, I want management that thinks like owners, that allocates capital intelligently, that's honest and competent. Bad management can destroy even a great business, and good management can compound value for decades. Fifth, I want to buy it at a price that makes sense. Even a wonderful business is a terrible investment if you overpay. I need a margin of safety, a discount to intrinsic value that protects me if I'm wrong or if things don't go as well as expected. Now, when I apply these criteria to the AI sector, very few companies pass the test. Most are speculative, unprofitable, trading at absurd valuations with no clear competitive advantage. But there are some companies that are using AI effectively as a tool to improve their existing businesses. Companies with strong brands, loyal customers, and the scale to implement AI better than competitors. For example, I'd be much more interested in a company like Microsoft, which is integrating AI into its existing products like Office and Azure, than I would be in some speculative AI startup. Microsoft has massive scale, a huge installed base of customers, predictable cash flows, and the resources to be a leader in AI implementation. Similarly, companies like Alphabet with Google or Amazon with AWS, these are established businesses with real competitive advantages that are using AI to enhance what they already do well. The key distinction is this: I want businesses that use AI as a tool to serve customers better and generate profits, not businesses that exist purely to speculate on AI's potential. So how should you protect your wealth during what might be an AI bubble? Let me give you very specific guidance. First, avoid individual speculative AI stocks entirely. I don't care how exciting the story is, how revolutionary the technology supposedly is, or how much your nephew swears it's going to 10x. Don't do it. The odds of you picking the winners are extraordinarily low, and the odds of you losing most or all of your investment are quite high. Second, if you want exposure to the technology sector, including AI, do it through a low-cost index fund. An S&P 500 index fund automatically gives you exposure to all the major technology companies that are implementing AI successfully. You get Microsoft, Apple, Alphabet, Amazon, NVIDIA, all of them without having to pick winners. And here's the beauty of index funds. When some AI company emerges as a real winner and grows big enough, it automatically gets added to the index. You don't have to predict the future. You just own the market. Third, keep your emotions completely out of investing. When you see AI stocks going up 50%, 100%, 500%, you're going to feel like you're missing out. That feeling of FOMO, fear of missing out, is what drives bubbles. Resist it. Remind yourself that you're not trying to get rich quick. You're trying to preserve and grow wealth steadily over time. Fourth, never ever use margin or borrow money to invest. This is how people get completely wiped out during crashes. They borrow money to invest, the market crashes, they get margin calls,
They're forced to sell at the bottom. Their wealth is permanently destroyed. Don't let this happen to you.
Fifth, maintain a significant cash reserve. Cash feels like it's losing to inflation, especially when you watch stocks soaring. But cash is optionality.
Cash is the ability to act when opportunities arise. Cash is the cushion that lets you sleep at night when markets are crashing. For someone over 50, I'd suggest keeping at least 1 to 2 years of living expenses in cash or cash equivalents.
Sixth, if you're still regularly investing, use dollar cost averaging. Invest a fixed amount every month, regardless of whether the market is up or down. This removes emotion and timing from the equation.
You'll automatically buy more shares when prices are low and fewer when prices are high. Seventh, focus on businesses with actual profits and cash flows. I don't care how exciting the growth story is. If a company can't generate profits and cash, it's speculation, not investment. There are plenty of wonderful businesses that make money right now, today, and will continue making money for decades. Buy those. Now, some of you might be thinking, but Warren, what if I want some exposure to AI? What if I don't want to miss out entirely? I understand that impulse, though I'd caution against it. But if you absolutely feel you need some AI exposure, here's how to do it safely. First, limit it to a very small percentage of your portfolio. I'm talking 5 to 10% maximum. This should be money you can afford to lose completely without affecting your retirement or standard of living. Think of it as speculation, not investment, and size it accordingly. Second, don't try to pick individual stocks. Buy a diversified technology ETF that includes many AI-related companies. This way, you're not betting on one specific company winning. You're betting on the sector as a whole, which reduces your risk dramatically. Third, go in with a long-term perspective. If you're buying because you think AI will be transformative over the next 10 or 20 years, not because you think the stock will double in 6 months, you'll make much better decisions. You won't panic sell during downturns. You won't chase performance. You'll just hold and let the technology mature. Fourth, ignore the day-to-day volatility. These stocks are going to swing wildly. Up 20% one week, down 15% the next. If you're checking prices daily and reacting emotionally, you're going to make terrible decisions. Set it and forget it. Let me tell you what Charlie Munger would say if he were here. Charlie passed away recently at 99, but his wisdom lives on in everything I do. Charlie had zero patience for speculation and foolishness. He'd look at the AI bubble and say something like, "Why would I want to compete against people who are happy to lose money? Let them have their fun. I'll buy businesses that actually make money."
Charlie believed that investing was fundamentally about understanding businesses and paying sensible prices. He believed most trading was gambling disguised as investing.
And he believed the secret to wealth was avoiding stupidity rather than seeking brilliance. One of my favorite Charlie quotes is, "It's remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid instead of trying to be very intelligent." That's exactly right. You don't need to be a genius to do well in investing. You just need to consistently avoid doing dumb things. And here's what Charlie would consider dumb: paying 100 times sales for an unprofitable AI company with no competitive advantage, no clear path to profitability, and no margin of safety. That's not investing. That's gambling. And Charlie didn't gamble. Charlie also used to say, the first rule of compounding is to never interrupt it unnecessarily. What he meant is that once you've set up a sensible, diversified portfolio of quality businesses or index funds, the biggest danger is that you'll mess with it. You'll get tempted by some hot stock. You'll panic during a crash. You'll try to get clever. And every time you interrupt the compounding process, you cost yourself money. This is especially true with bubbles. The temptation to chase bubbles is enormous. Everyone around you is getting rich, or so it seems. You feel like you're being left behind. But if you stay disciplined, if you stick to your principles, if you let compounding work uninterrupted, you'll be far wealthier in the long run than the people who chased every shiny new thing.
Charlie would also remind you that bubbles always end the same way. Always. The only question is when, and you can't predict that. So the smart move is to just avoid them entirely.
Don't try to ride the bubble and get out before it pops. You're not that smart. Nobody is. Just stay away. So let me bring this all home with some final thoughts. Artificial intelligence is real. It's going to be hugely important. Companies that effectively harness AI will have enormous competitive advantages over the next few decades. But that doesn't mean you should pay any price for exposure to it. That doesn't mean you should speculate on unprofitable startups. That doesn't mean you should abandon the principles that build lasting wealth. The principles that have worked for over 80 years still work today. Buy quality businesses at reasonable prices. Maintain a margin of safety. Stay within your circle of competence. Keep emotions out of investing. Think long term. Let compounding work its magic. These principles are boring. They're not exciting. They won't make you rich overnight. But they work. They've made me one of the wealthiest people in the world, not because I'm smarter than everyone else, but because I've been more disciplined and more patient. You don't need to participate in every mania. You don't need to chase every hot sector. You don't need to fear missing out. What you need is to protect what you built, make sensible decisions, and let time do the heavy lifting. The AI bubble, if that's what it is, will eventually burst. It might be this year. It might be in 3 years. I don't know. But when it does, the people who stayed disciplined, who avoided the speculation, who owned quality businesses at reasonable prices, they're going to be just fine. They'll probably be buying assets from the panicked speculators at bargain prices. And the people who chased the bubble, who speculated with money they couldn't afford to lose, who used leverage, who bought things they didn't understand at prices that made no sense, many of them are going to lose fortunes. And I don't want that to be you. Remember what I said at the beginning. I've seen this movie before. The technology changes, the companies change, but human nature stays the same. Greed and fear, boom and bust, mania and panic. It's all happened before, and it'll all happen again. Your job is not to predict when the bubble will pop. Your job is to protect your wealth by staying rational when everyone else is losing their minds. So here's my final advice. Avoid the speculation, stick to quality, maintain discipline, think long term, and never, ever forget that price is what you pay and value is what you get. Just because something is exciting doesn't mean it's a good investment. I've made my fortune by being boring and disciplined for over 80 years. You can do the same. You don't need to participate in the AI mania to build wealth. You just need to be patient, rational, and consistent. Thank you for your time today. Now, go out there and make sensible decisions. Protect what you've built. Avoid the temptations of speculation. And remember, rule number 1 is never lose money. Rule number 2 is never forget rule number 1. Stay safe out there. The AI revolution is real, but that doesn't mean you need to gamble on it. Invest wisely, invest patiently, and let time do the work. Good luck to all of you, and